How do we actually understand how risk exposed a portfolio is? One way is to measure risk through beta. Beta is financial jargon for portfolio correlation, and in today's example, we'll be looking at beta as measured against the S&P 500 stock index. Higher betas show more historic sensitivity to market gyrations, and lower betas less so. Here's how that works. A beta of 1 is intended to stay in relative lockstep with the S&P 500's performance. A beta greater than 1 may outperform the index when things are up, but we'll see even larger losses in the S&P 500 when the index is down. In contrast, a beta of less than 1 suggests less market sensitivity. If the S&P 500 rises, the investment may not increase as much, but it also likely won't lose as much value in a negative scenario. Why is beta so important? Because it helps us actively measure portfolio risk in a given market environment. Risk that we may want to increase or reduce depending on the current data at the time. As CWM, our research has shown it's more important to help safeguard against the downside or market losses than to capture all of the up or potential gains. We aim to sustainably maintain and increase the value of client assets and purchasing power over time. We manipulate beta across client portfolios with that philosophy in mind. If we set a low beta, portfolios will hold historically less market-sensitive assets like U.S. Treasury bonds. In times where a higher beta makes sense, riskier investments like high beta tech stocks may be a good fit. Finally, how do we determine a beta target for CWM clients? Our portfolios typically have different betas based on various risk tolerances, which are selected by clients in collaboration with their advisor. Each one of those portfolios is then managed by feeding a variety of factors into our proprietary database machine learning models. Models that utilize data related to the economy, market price momentum, interest rates, human behavior, and valuation. Using current data, past historical performance, and informed predictions, we can create a view for intentional planning to pursue our clients' financial and lifestyle goals. Past performance can never be a guarantee of the future, of course. It can only help us make informed opinions about the present and future potential. If you have questions about beta or other indicators that support informed, intentional investing, give us a call. We're always happy to help at Comprehensive Wealth Management.